Hey, welcome back. If you're new here, this channel is about trading with clarity. No hype, no shortcuts, just frameworks that actually work over time. Today we're talking about one of the most misunderstood parts of trading, and honestly, one of the most expensive mistakes I see people make over and over again. It's about entries. Specifically, it's about why trying to buy the bottom is costing you money and what to do instead. Let's get into it. The trap most traders fall into, so here's the setup. A stock you've been watching drops hard. Maybe it's down 20%, maybe 30%. Something happens in your brain. It starts to look cheap. It starts to feel like an opportunity. There's this urgency that creeps in. I don't want to miss this. It has to bounce from here. So you buy. And then it drops another 10%. And then another. And now you're sitting in a losing position, watching it go lower, wondering what you missed. What you just experienced is called catching a falling knife. And it's not a sign that you're a bad trader. It's a sign that you were asking the wrong question. Most traders in that moment are asking, is this the bottom? But that's not the question that leads to good trades. The question that leads to good trades is the trend starting to change? That shift in thinking, that's what this video is about. Why the bottom doesn't matter. I want to be direct about something. The goal of a good entry is not to buy the lowest possible price. That sounds counterintuitive, especially if you've been taught that trading is about buying low and selling high. Think about what buying the bottom actually requires. It requires you to be right at the exact moment when nobody else is. It requires you to enter when the chart looks terrible, when the news is bad, when sentiment is negative, and when there is zero confirmation that anything has changed. That's not an edge. That's a guess with a good story attached to it. What actually creates an edge is recognizing the transition. Because markets don't reverse instantly. They transition. There's a process that plays out before a new trend begins, and that process leaves footprints. Your job is to learn how to read them. The 4 signals to watch. Let me walk you through the 4 signals I look for when I'm trying to identify an emerging trend. These aren't complicated. You don't need fancy indicators or a screen full of tools. You need to train your eye to see what's already there. Signal 1. A shift in structure. Every trend has a structure. In a downtrend, price is making lower highs and lower lows, one after another. Each rally gets sold. Each new low is lower than the last. That's the pattern. But at some point in a real reversal, the structure quietly changes. The stock forms a higher low, and then it breaks above a previous high. That's it. That's the first footprint. It's not dramatic. It doesn't make headlines. But it's meaningful because structure always shifts before price accelerates. If you can't identify a higher low on the chart, you don't have a trend change yet. You have a bounce. And bounces fail all the time. So the first thing I'm looking for is, has the structure begun to shift? Signal 2, momentum, reclaim. The second signal is about momentum, and one of the clearest ways to read momentum is through the 20 EMA. That's the 20-period exponential moving average. In a declining market, price consistently stays below the EMA. Every time it tries to rally up toward it, sellers step in and push it back down. The EMA acts like a ceiling. In an early trend shift, something different happens. Price reclaims the EMA. It pushes through, holds above it, and starts to use it as support rather than resistance. That change in behavior, from rejecting the EMA to holding above it, tells you the character of the move has shifted. Sellers are no longer in full control. Signal 3. Selling exhaustion. The third signal is subtler, but once you see it, you can't unsee it. Before trends reverse, sellers start to run out of steam. You'll see it in the candles. Those big, aggressive red bars that were pushing price lower start to shrink. Lower wicks begin to appear, which tells you buyers are stepping in and absorbing supply at the lows. Volume during down moves starts to fade. None of this means the stock is about to explode higher. What it means is that the urgency to sell is fading. The conviction isn't there anymore. And when selling pressure weakens, it creates the conditions for buyers to take control. You're not looking for a dramatic shift. You're looking for sellers to get tired. Signal 4. Breakout from consolidation. The fourth signal is where confirmation happens, and honestly, it's my favorite part of the process. After a stock stabilizes, it usually enters a consolidation phase. Price starts moving sideways in a relatively tight range. It's quiet. It's boring. A lot of traders completely ignore this phase because nothing seems to be happening. But this is actually where the setup is forming. Supply and demand are reaching equilibrium. The stock is building energy. And when price finally breaks out of that range with real conviction, strong candle, strong volume, it's telling you that demand has overtaken supply. This is the entry point. Not at the bottom, not in the middle of the decline, but here, at the start of a confirmed move. Putting it together, the process. So how do you actually use this? Let me give you a simple sequence you can follow. Step 1 is stabilization. You're waiting for price to stop making new lows and start moving sideways. Until that happens, there's nothing to do. You're just watching. Step 2 is the higher low. Once the stock has stabilized, you're looking for the first sign that buyers are defending a level, a pullback that doesn't go as low as the previous low. That's your first green flag. Step 3 is the momentum reclaim. You want to see price push back above the 20 EMA and hold. This confirms that the behavior has changed from distribution to accumulation. Step 4 is the entry. You enter when price breaks above a clear resistance level or a prior swing high. This is your confirmation. This is where the risk to reward makes sense. This process won't get you the absolute lowest price, but it will get you an early entry with evidence behind it. And over time, that is worth far more than any bottom you could guess at. The mistake that kills accounts. Before I wrap up, I want to address something directly, because I see this constantly, and it costs people a lot of money. There's a habit in trading of confusing price with value. A stock being down 40% does not make it a good buy. Oversold does not mean safe. Cheap does not mean low risk. A falling stock is not automatically an opportunity. Without structural confirmation, buying a declining stock is guessing. It might feel like research. It might feel like conviction. But if the 4 signals I just described aren't present, you're acting on narrative, not evidence. And trading on narrative without confirmation is one of the most reliable ways to blow up an account slowly. Why this matters for leaps. Now, if you trade leaps, those are long-term options contracts that expire anywhere from several months to a couple of years out. This framework is especially relevant to you. With leaps, the goal isn't to scalp a quick move. The goal is to position yourself in a developing trend and let time work in your favor. That means timing isn't about being fast. It's about being right on direction and entering when the evidence supports it. A leaps position entered during a confirmed trend shift, after stabilization, after the higher low, after the momentum reclaim, has a completely different risk profile than one entered while the stock is still in free fall. You're giving yourself the best possible starting position for a multi-month hold. That's the game. Not catching bottoms, catching beginnings. The real edge. Summarized. Let me leave you with a simple way to think about all of this. Entering early without confirmation leads to losses. Entering late leads to poor risk to reward. Entering early with confirmation leads to consistency. That middle path, early but with evidence, is the actual edge. It doesn't feel rushed. It doesn't feel emotional. It feels calm. It feels structured. It feels like the market has already begun to change, and you're simply stepping into alignment with what's already happening. That's the trade worth waiting for. If this resonated with you, hit subscribe because this is the kind of content I put out regularly. And if you want to go deeper on leap strategy and trend timing, I'll link to some related videos at the end of this one. I'll see you in the next one.